Stocks tumbled yesterday after investors got a close look at just how quickly the Federal Reserve is looking to both raise interest rates and cut the amount of bonds it's holding. Is that a healthy reaction, would you say? John Ford is back to weigh in on that. Hey, John.
Hey, Mike, healthy? You tell me. Well, the NASDAQ dropped 3.3% in one session, and that's really mild considering what a lot of individual stocks did. I mean, Roku was down almost 12%, Salesforce down 8%, Adobe 7%. That's ugly. And the problem isn't just the Fed balance sheet reduction or just the plan to raise interest rates. It's the surprise that the Fed wants to do both at almost the same time as quickly as possible. I mean, what could go wrong? Oh, well, have we forgotten the taper tantrums already? May 2013, the Fed just talked about cutting back on asset purchases. Then the S&P dropped around 5.5% in about a month, and the 10-year went from around 2% to 3% in December. And then in the second half of 2018, the Fed started talking tough about cutting asset purchases again and raising rates at the same time. Between September and Christmas Eve, the S&P dropped 20%. Call that sane? Look, I get it. A lot of people think the market's overheated, whatever. The Fed officials are doing all this talking, all this signaling all the time to avoid lurches and moves like this. This isn't sane. It's evidence of a problem, Mike.
Is it? But isn't there, a lot of genuine pressure for the Fed to act at this point?
Well, Mike, on the other hand, markets are not in turmoil here. I mean, let's not freak out about a 3.3% drop in the NASDAQ. For a little more perspective, the S&P was down less than 2% yesterday, and it just touched record highs the day before. Apple touched an all-time high and a $3 trillion market cap on Monday. I mean, with yesterday's violent slide, the S&P plunged to levels not seen since the Wednesday before Christmas. And the NASDAQ plunged to December 20th levels. Yeah, 2 weeks ago. Meanwhile, for those concerned about little things like the real economy overheating, the ADP jobs report yesterday said employers added 807,000 jobs in December, more than twice what was expected. So, yes, the Fed's going to raise interest rates and downsize the bond holdings when the markets are at all-time highs. With inflation spiking and hiring booming, that's okay. That's what's supposed to happen. The Fed is giving the economy a cold shower, and that might force the market to sober up a little bit after a 27% rise in the S&P in 2021. What's it called? Myopic loss aversion? That idea that when you measure the market action each day, you freak out about the drops and shrug off the gains. It's a classic investor mistake. That's exactly what's happening here, Mike.
Well, it's absolutely good context. I know that studies have shown that basically the biggest correlation to bad investment performance over time is people who look at their statements every day or look at their accounts every day. So when then is it time to worry? Because, it isn't as if it's just the Fed that was leaning on things like the software sector.
Yeah, I mean, as you know, Mike, we talk about this every day, which is why we've got to be careful about this. But it's not just one day at a time. We got to look at the overall trends. Remember that Apple did just hit $3 trillion. And, is this the start of something bigger? Maybe. I remember last January, we were caught up in the meme stock trade, and the meme stocks were getting hammered yesterday. It's a long game, right?